and welcome to, I think, one of the key sessions today. We are going to talk about returns. I think this is the key question in venture capital. I have a distinctive panel today, and I will let all panelists introduce themselves. They represent different funds with very distinctive strategies and probably very different approach to how they think about returns and generating returns. So just a few words about myself. I'm Ekaterina Almasque. I'm in venture capital for now 20 years. I was very lucky to start actually doing that back in the Bay Area, and then also have spent some time in Latin America investing. But most of my time I'm actually investing in Europe. And I think having raised several funds and having investables in funds out of Europe, I think it's a very keen question for us going forward, whether we can actually demystify some of the data that is always shown to us about European returns, and also kind of continue provide strong returns going forward in these crazy times with AI and so on. So with this, let us introduce the panelists. So Evie, please.
Thank you. Good morning. It's you all. Thank you, Ekaterina. The Evie Mulberry, I'm managing partner at Astia. We're a San Francisco headquartered venture firm. We are currently investing from a Series A and B stage fund. We've deployed $50 million into 66 companies over the last 25 years. And we've had 17 exits, talking about exits, and 3 of which were IPOs and 14 M&A. Personally, I've been at Astia 17 years, so I've been there the whole time of raising all the capital, deploying all the capital across, I think it's 180 deals at the moment. And before Astia, all those years ago, I was a finance lawyer, worked in private practice and in-house at an investment bank.
My name is Cherepnin. I'm a managing director at EGF Capital. EGF is an alternative asset manager. We're headquartered in DC. We're about 20 years old, 50 people, about $5.5 billion of AUM. I'm a partner on the venture capital strategy, which is one of the smaller and high growth parts of the firm. We manage about $200 million on the VC side of things. We're on our second fund now. We focus primarily on bank tech. So we invest in pretty much anything you can sell to a small and medium-sized bank in the US and in Europe. And the reason for that is us building on the network that EGF's built in the banking space. So EGF is one of the most active investors in the small and medium-sized bank community in the US. So community banks, regional banks, banks with about 1 to 50 billion in assets. So that informs how we invest. We've got about 20 portfolio companies. In the first fund, we're about to start investing out of the second fund. We're a Series A investor primarily, so $2 to $5 million checks. And we have a couple of portfolio companies here in the US, so not as many exits just yet. More of an emerging manager, but keen to talk about what we see in the market.
Thank you. Thank you, everyone. I think, I was at a loss of words when I just realized I'm on a stage with American headquartered funds and we're talking about returns and exits. It's going to be interesting representing the European fund here. So my name is Varun. I work at Speedinvest. Speedinvest is a 1.2 billion AUM fund, which was originally started out of Vienna, Austria. We have 5 offices across Europe. We're known as a seed fund, seed ethos, been around for 12 years, investing out of our flagship fund, number 4. We've had about 47 exits, no IPOs in there, primarily M&As. So there's going to be an interesting story on that. And then I co-lead sort of our growth fund, which is a 300 million fund that sits on top of the seed fund. So we double down not only on our best companies at seed, but we also sort of do outside investments. And sort of excited to have that take here because I come from a capital markets background in New York, an investment banking background from Singapore, and I'm originally from India. So I like viewing capital markets and sort of returns as a whole globally. And I think it's going to make for a very interesting discussion.
Sounds good. Thank you so much. So let's start straight away with some specific questions, for example, about fund model and portfolio construction. I would like to ask you a question, and Varun, maybe start with you. you are saying that actually fundamentals for the good exit are laid before, way before the exit and coming. And I know that you have been advising, I think, about 70 tech exits, tech IPO exits in the US, and now you are seeing Speedinvest. Can you tell us what are these fundamentals? So how can you think about fund model or portfolio construction way before, like way before you have to exit those companies? And how do you think about that at Speedinvest?
Right. I think there are two takes to that, right? One is internally, how do you think about fund model and construction? And the other thing is, how do you manage that if you're in a board capacity, right? How do you manage that from a governance perspective? So I'll address the latter first. So on the latter, one thing that we saw when I was I was in an advisory role at PwC, which was in sort of a new team that we had built, working on IPO readiness for a lot of VC-backed companies. We actually started engaging with the companies at Series C, right? US companies at Series C growing 100% year over year after the 30 million ARR mark. And what that taught me was that at that level, engaging with these companies to start working across all functional areas of the business to streamline them, improve them, and get them ready for future crossover rounds and a potential exit. It was almost that the companies and the advisors and the stakeholders in the board were all ready at that point to start thinking about a liquidity event, right? It wasn't even on the horizon at that point. I think we can sort of add more to this, but that's one narrative. And how we see that now at Speedinvest is 3 years ago, we created something called a DPI team, right? The purpose of this team was to identify companies very, very early on, have open conversations with the investment managers and the board member to say, look, what do we think this is going to be? Like, did we underwrite this for what sort of exit? Is it a 5, 10, 20, 100x? And it requires a bit of self-awareness and honesty in that sense to say that we really need to make a move here. And we sort of prioritize those companies in terms of how we sort of take them on roadshows, right? How we introduce them to the network across EMEA, across the US, and actually be able to drive that exit. Now, how this impacts portfolio construction, I'd be lying if I told you it did, because it's not, right? The fund models for our flagship fund 4, 5, it's all the same. We're still underwriting it on power law. We're not changing it.
Yeah. Thank you so much. I think we'll come back to the power law because of this 10-20, we'll discuss a little bit more. Let's just stay a little bit more on the topic of portfolio construction. And Evie, I want to ask you, and I was very glad to see you on this panel today because your fund is actually backing a lot of female-led businesses, like women-led businesses, and there is a lot of discussion that it's kind of like reduces your pool of choice and maybe even might affect your returns. I would be very curious to hear how do you think about this and whether you had this question from LPs when you're fundraising.
Thank you. We've got to share our mic. I actually think about it, and along with our partners, very differently from closing the pool, because actually we're broadening the pool at the top of the funnel. So rather than excluding men, this is about including women in those teams. So our criteria is not women only. This is, we just want one woman at senior level in the exec team on the cap table. So actually the pool's pretty broad, and venture capital is all about seeking those hidden gems where when you look at the deployment of venture capital, it's very narrowly deployed, whereas actually I'd actually flip your question around in that we're broadening the top of the funnel and not limiting it. And yes, we do get the question asked by LPs, but it's a conversation. It's not a conversation stopper. Yeah, sure. And then also on the fund construction model, we're actually the opposite. We're very high conviction, so we're not backing and relying on one of those portfolio companies returning our fund. We're looking at returns across the fund. Yes, there'll be failures. This is early stage investing. There's risk, but really it's about that high conviction portfolio construction model. And yes, we do get that exact question from LPs. But in terms of the LPs we have in our fund, it's all about returns first. And we've been able to show over the 13 years that we've been investing and our synthetic portfolio before that, when we were an accelerator, that actually when you have inclusion at the top of the funnel, the performance shows throughout. So, and it CFO of Mastercard was okay with it. So I feel like that's pretty high bar to have met.
Perfect, very good. And then, Michael, to your question. So you have chosen specific sector to go after, which is financial services, and you go after early stage. And I know you are early in your journey, but can you talk about, was it your choice of sector influenced by returns, expectation of returns, or how do you think about it? And also, like, being where you are today, what do you think you could do to actually accelerate returns and exits?
Yeah, sort of to the point that Chris made earlier, right? There's this bifurcation in the asset management space. It's been going on for a while, where asset managers either go big or go niche, right? So when you think about Blackstones, KKRs, others of the world that are one-stop shops that do private equity, private credit, real estate, pretty much anything. And sort of in the venture space, there's a similar trend where you have recent sequoias with large operating teams, with partners that can advise on anything from go-to-market to hiring, to anything you need to do as a founder. And they grow to 10, 20, 30 billion of AUM. There was a screenshot with Lightspeed's name on it earlier today. So there's one category of people, and the other category is niche, right? And the squeezed people in the middle, there was really struggle. So people in the middle who try to do everything but don't have the resources to compete with those larger firms. So that's sort of that's the thesis that kind of drove us to focus on fintech. And if you're a niche player, you have to know your space really, really well. So in our case, fintech is probably one of the largest addressable markets within venture. Payments alone is a $1 trillion per year volume industry. And then on top of that, you have financial software, capital markets, all that stuff. So within fintech, even if you say you're a fintech investor, that's not niche enough in my view. So we focus on bank tech, and as I mentioned, the reason for that is EJF's heritage of investing in banks, right? So we're a capital provider across the stack, from equity to credit, from public to private. So when our portfolio company is selling a software, AI, blockchain product into that ecosystem, we know what banks will be interested. We know what banks focus on SME lending, what banks focus on credit cards, what banks focus on wealth, and what it's and so on and so forth. So I think it's very important to know your industry to be able to differentiate. If you're not, one of the larger players with the resources, and you're going about the opportunity as a generalist. As far as sort of the portfolio construction, by the way, I think what also drives it is fund terms. So typical venture fund is 10-year term with a 5-year investment period. I mean, there are deviations from that, and it can go up to 12 with a couple of extensions. So within that 5-year investment period, that at least how we thought about it in the first fund, as you approach the end of it and you have maybe 1, 2, 3 bullets left, you need to be thinking about the exit timeline, right? So do you really want to back a pre-seed company that is going to take 10, 12 years to exit when you're in year 6 or 5 of your fund, right? And you'll have to go through the headache of the LP voting on extensions and whatnot. So I'd say we at least are less likely to invest in a seed company in years 3, 4, 5 than we are in years 1, 2, 3. And we're more likely to invest in a sort of a late Series A or pre-Series B opportunity. And so if you're a founder, that's what I would be asking your VCs, sort of where are you in your fund life cycle, et cetera, to sort of inform how they're thinking about it.
I totally echo. I know I don't have a mic, but I completely agree with everything that was just said. I think it's really important as an entrepreneur to be asking those questions so that you are spending time with the right people. And sitting on the fun side of the table, we're never going to be offended by that sort of question, because actually it just shows that you have an understanding of what we as fund managers are working towards in terms of the returns and our fund profile and how we're deploying capital.
So this is very interesting, but let's talk a little bit more about timelines and expectations of multiples. And I will ask you now, each of you, to give actually concrete examples of a exit which drove, for example, which was a fund returner, and an exit where you hoped it would be like super big, but it actually didn't happen. And while you're thinking about it, let me give you a little bit of background. So I'm a deep tech investor. So, and I would doubt. So I would actually challenge that a company takes only 10 to 12 years to IPO, because most of the cases, like we know UiPath, whatever, it's 15 to 12, 20 years. It's super patient capital. And we know like the ones that the best outcomes actually take time. And being patient. So in my case, I had like 3, 4, 5 IPOs in my life, and most of these companies went almost like 4 or 5 times bankrupt during their journey. So it was always like for 10 years, you kind of sit there, and every time you think, oh my God, this company is going to survive, or what's going to happen? And then were other cases where actually, we are all venture capital. We are multiple driven investors, but then there were cases where actually multiple wasn't that great, but IRR was amazing, like IRR, because you exit within a year, and you don't feel very good about it because of the value creation, but it looks good on paper. So I would want to ask you a very concrete question, that can you think about and give this to the audience, share your experience. How did you think about this one maybe very great exit, and how was your journey there? Who wants to start?
I think it's important to highlight one point that I've observed being in London for the last 4 years here, is that Europe, UK, India, China, for that matter, all the countries that are doing sort of large markets in venture capital, we've all imported the model of American venture capital without really fine-tuning it, right? The model was started for SaaS companies growing at a certain rate, and then the 0 to 8-year timeline worked. Funds worked, DPI worked, returns were made, people were happy, kids went to private school, it all worked. Does not work that much lately, right? And I want to highlight a specific example, which makes a case where a fund returner for us was a very, very atypical company out of Austria, which a lot of you may not even know. But it's one of the largest crypto exchanges in Europe. It's a company called Bitpanda, right? And Bitpanda was a bootstrapped company, has not taken much capital besides us and Valar Ventures and a few other funds. But we backed the company very, very early on, sort of before their Series A. They did not need capital. They were unit economics positive, building a cryptocurrency exchange. And fast forward to today, well, we still have exposure there, but it's sort of been a fund returner for us. And what was our conviction at the time? Conviction at the time was we believed in a more macro view, which was going against the typical fundamentals of how we view the fund. It was a company that was growing, unit economics positive, but not growing the way we expected the company to grow. It wasn't breakneck 100% year-over-year growth, but there was a macro view that the GP at the time took a bet on, and then we sort of kept doubling down with our growth fund and so on and so forth. So I think what I'm trying to sort of bring this message out is that we all as an industry need to be a bit more cognizant of this fact that the model needs to be fine-tuned a bit for the economy that we're in, and not taking the US metrics as the North Star, and then being able to adjust that in our conversations with LPs, and LPs playing an active part in this as well, right? Obviously, it's all mathematical, right? At the end of the day, the IRRs have to make sense, but those conversations need to be had, right? So
I appreciate you highlighting in the question that, the time returns are longer. Venture is a longer term games, right? And yes, we hear about a lot of quick exits in the press, rapidly scaling companies, and obviously there are those examples, but across the portfolio and across time, it does take time to build a company. So thank you for highlighting it. I don't think it's the cool thing to say these days. And I think exits to timelines, the data shows that since 2005 they've been extending. So yes, it's not a great time right now for exits, but it's been, that timeline to exit has been getting progressively longer for a long time. And in terms of an exit that we took, we were proud of, is Envision, which is a diagnostic company for ovarian cancer. And Serbi Sarna was the founder. She could not raise capital on Sandhill Road because she had to talk about, I'm going to be quite frank, female body parts that people didn't want to be talked to about. And so she found Series A quite hard to fundraise. She eventually raised 17 million, and before exiting to Boston Scientific, 275 million. So in terms of metrics in exit, it was incredible because of the amount of capital she raised. She was so lean, unfortunately, because she was undercapitalized. But in terms of us as investors, it worked out for us pretty well because at exit, we were the second largest investor. And especially when we participated at Series A, that the fund returns and economics and that were pretty good. And then in terms of an exit that surprised us, I think one of the companies in our portfolio before our current fund, Soapbox Labs, is an Irish company, speech recognition. You've heard of it, yeah. An amazing founder, PhD, and Trish Scanlon. And when we were thinking about it in terms of metrics, revenue growth, commercialization, for us as the external investors, it was very much, well, is she hitting the metrics? Is she growing? Where's the revenue? Where's the revenue? And she was, as a PhD, refining the, that there was a lot of R&D, but actually she sold the company at a point where we thought she would need to commercialize a lot more, but trusting the entrepreneur to know the space, to know really where they need to be at that exit. So actually it ended up being a good exit for us, but it wasn't one we were expecting at that time. We as her investors expected it to be a lot longer time horizon because we didn't see those commercialization, that hockey stick growth of commercialization that we're all told to look for wasn't there. But yet that doesn't mean that the exit's not around the corner.
I don't have much to add in form of examples because our portfolio is still quite young. We do have a lot of companies that do really well. But what I would say is the common wisdom has been that there are two options to exit: IPO or M&A, right? And I don't think it's the case anymore, or at least over the next, call it 3, 4, 5 years. I think that's going to change because when you look at the sliver, like the very top of the best VC-backed companies, your Stripes, Databricks, SpaceX, as others, it's becoming more liquid through the secondary space. It's becoming more liquid for early backers, for employees. There are a lot of firms, startups actually working on it. So NASDAQ has a big initiative called NASDAQ Private Market. London Stock Exchange is working on it. They have a few initiatives. So I think that's going to evolve, and that sliver of liquidity for privately held companies is going to increase. So the pressure to go public or sell yourself will not be as strong as it is right now. We're not there quite yet, but I think that will change, especially as managers attract capital from the retail space and the wealth space. There's a big push in that vertical right now. So there'll be more capital to go around. There'll be new fund structures, vehicles, more opportunities for people to participate in venture capital. I actually wrote an article about that last month. And I think the pressure from LPs will still be there, but the opportunities for GPs to get liquidity will be more and broader.
Great. Thank you so much. And I think a lot of people in the audience would want to know, how do you actually take the decision, the hard decision, when the company is not doing, let's say, so great, but you still need to, you still believe, you have maybe conviction, maybe not, but you need to take this hard decision of financing further the company or not. And sometimes it's a down round, sometimes you cannot find the lead investor. And these are very difficult situations. I can tell, like, one of the IPO that we had, basically the company, for 3 times we had, at the very early stages, we had to take this decision and finance the company by ourselves, because like there was a long list of top investors who always said, yeah, we want to, but they never came in. And we had, and then it was a very good IPO and, like 3 times fund return, but it was this very difficult journey. So do you have an internal book? And everyone talks about this. You have to be tough as a venture capitalist. You have to take these decisions. But do you have an internal book, how you actually act in those situations?
Nobody likes to talk about this, obviously. Nobody's jumping to answer that question. I would say we don't have a book per se, because I think it depends on company by company basis. You have to have, like you said, grit, determination, and to stay the sticking course. And I think when you look back, 17 years, I suppose, there's ups and downs, and you've got to make sure that you can follow your conviction. I think the most important thing has been close to your portfolio over time. And I don't mean just showing up to board meetings. This is the between the board meetings. This is the really important stuff. You know, not just for the negative, you know, can you help them with the opportunities in front of you, but also are you there for them when you know the challenges? And I think as long as you can have that close relationship with your portfolio, I think then you know which portfolio companies you want to back and double down on, and you get an insight into how that team operates over time rather than just that one flashpoint, like you were saying. It'll happen multiple times. So I don't think we have a playbook because it's definitely case by case. And it's, yeah, and nobody wants to talk about it.
Yeah, VCs don't want to talk about down rounds, do we? I think that we have to separate down rounds from bridge rounds, right? Because if the company's struggling, but you still got conviction, you as sort of royal, you existing shareholders, VCs and whatnot, then you just bridge them, and there's no need to take a markdown, right? So you don't do a new down round. Down rounds happen when there's a new investor coming in. That's actually helpful because there's extra validation from a party who's not been involved, and there are various structural instruments to effectuate that. One instrument that has been popular in particular, well, it was popular around 23, 24, during sort of the tough valuation environment, is a pull-up structure, right? When as a new VC you come in and you want to incentivize existing shareholders to join you, so you penalize those who don't participate in the round by either diluting them, and you incentivize those who do participate by pulling them up into the new sort of capital, the liquidation preference stack. So that's one instrument. There's a lot of structure, there's a lot of financial engineering, but to what Evie said, it's all about conviction. If you have conviction, you keep supporting the company, and the way to build and maintain that conviction is by being close to the company, to the founder, and by speaking with the customers. If the customers are happy, if there's traction, if the company is growing, great. But you need to, if not, you just need to understand why and form a view. And we did have a scenario where we lost conviction in the team, and we had to wind down the investment. So these things also happen, but and that's power law, right?
Can I say something? So the pay-to-play provisions you were talking about for any entrepreneurs in the room, obviously sometimes that's the only option on the table in terms of the capital to keep your business going. But those pay-to-play provisions are really tough when it comes to maintaining relationships with your existing investors for the long term. And I think I would say this talking as an investor, because they're against my interest, but I think you really need to think about them in terms of, are you going to ruin a lot of relationships that could keep your company going in the longer term? As a longer term view, yes, it might be the only option on the table and it might have to go for it. But I think those pay-to-play provisions, which sadly are increasing in their commonality, and just come with so much more nuance than just dilution on the cap table.
Yeah, I think I'm just closing off by saying that so we have a little bit of a process. We call these orange light rounds when there's a situation like this, and we see it as part of the portfolio update. In two situations right now, I'd just say it's painful, right? Because I think it's important to communicate from day one that, look, as much as we sell as a fund, we're founder friendly, as every fund is, I think it's very important to also recognize that first and foremost, we do have a fiduciary responsibility to LPs, right? As money managers. And those conversations are hard, right? When we say we're, not abandoning the ship, but we're not feeling the same confidence as you. And they're not good conversations. I think they're hard conversations. And I think depending on the region also, you're having this conversation. And like where in EMEA, for example, the conversation can change quite a bit. But I think it's just having this discussion more and more that it's tough. It's, and I'm in one of my first few conversations. You guys have obviously had a lot more. It's not easy, right? So
I totally agree. So I know that we only have time for one more question. So I'm abandoning the artificial intelligence discussion that probably can be another panel. So maybe we can discuss this over coffee. But the last question to all the panelists will be, so now the time is tough. Everyone is talking, look, everything is taking longer. The exit market is gone. Out of Europe is very difficult, and so on and so forth. And I remember that earlier in Europe, when you would have an early growth fund and say, well, I will be doing 3x fund return, everyone was like super cool. But in the US, it would be like, unless you do 5x, don't even talk to us. So my last question would be, what is now you would be promising your LPs with a kind of clear heart, and is there anything secret sauce that you can share with the audience that worked for you in the past that generated outsized returns? So kind of two questions in one, but this is for closing and kind of staying open for other conversation later on.
Okay, seed or growth, but okay, just generally for us as now becoming a multi-stage fund, I think secret sauces and we've published this as well, doubling down on headcount on a DPI unit, right? That really making this prominent, that there are 2 dedicated members who are responsible for creating DPI. What we said, I mean, the 3x, 5x case still works in terms of growth, and seed fund obviously different, but we're trying to highlight that a lot more, that we're making that effort. If I said anything else besides that, I think I'd be lying. So yeah.
Our secret sauce over time has been our expert sift, which is our screening process that we've used to mitigate the risk that comes into play when you're investing in early stage companies. We wrote a white paper, released that last week, in terms of, you can all read it, we're very open source Astia. And this is about sharing the ways that we look at deals from a more business opportunity and not just being informed by some of those social biases. And so read that. That's our secret sauce. And the other one is, and in terms of mitigating what we're promising LPs, I would say that the private equity partner on our team is very busy in terms of focusing. We might not call him the DPI person, DPI department, but absolutely thinking strategically, creatively. Everything comes into play right now so that we can get those returns for our LPs. I think their priority for returns has not changed and will not change.
If I'm an LP, I would be thinking about vintages. I hear it a lot. People say VC is a vintage game, and that's why a lot of LPs re-up with managers, because you don't want to miss the next great vintage. So some of the best vintages, I did some benchmarking on this a few years ago. Some of the best vintages were early 2000s, right after the crash, and sort of 2009, 2012, when the economy was in recession, and a lot of people sort of didn't want to stay. A lot of founders didn't sort of see a reason to stay in their jobs and start a company. So that's when a lot of the tech unicorns that we see today, the Stripes, the Airbnbs, the Ubers, and I'm conscious that I'm referring only to US examples. Apologies for that. So vintage is one, right? So I'd be thinking about, okay, is now a good vintage with everything that's going on in the world? And I think that actually, yes. So it's counterintuitive, but now is a pretty interesting time to be investing. And if you separate out the AI valuations, which are, the universe of their own, there's a lot of interesting opportunities out there. In terms of our secret sauce, it's really just the bank network. I can see the red flag waving. I mean, so we're done, but it's the bank network helping our companies access the US, helping our companies penetrate that ecosystem. There's 4,500 banks in the US. There's 4,000 credit unions. It's 9,000 companies. It's very different to the UK, where we've got 120 banks. So people expanding in the US are better off with a VC partner who's based there.
Well, thank you so much. We're out of time, but thank you for listening and staying here in the audience. Very insightful panel. Thank you so much.
Thank you.